Hey, what's up guys? Sam here, and I'll be doing the free video for February 11th, 2022. So, a rare video where we're actually doing it before the market closes, but I don't think much is going to change here in the next 40 minutes. So I think we can go ahead and clip it and ship it here. I wanted to show you just a couple things here. So the interesting thing about markets right here is actually that they are all basically just becoming one thing, right? It's just a big red green kind of button. And there are some spots that are outperformers, and we'll talk about those. And there's definitely spots that are underperformers, and we'll talk about those. But the big thing to understand going into next week is really just the indices and volatility, which is VIX. So I want to start here with the VIX signal because there's this pattern on VIX that's setting up where you have these higher lows and higher highs. And now you've put in a third higher low at 20. And this next push on VIX should take you into 40. So be very aware of that. Not only does it have the right pattern, but now it actually has a buy signal, and it has the right trend structure to really drive higher here, right? So I am looking for 40 on VIX very soon, and just be aware if that happens, that's going to take down the entire market. And then if we go to something like the SPY, you'll be able to see just kind of the damage that's been done here structurally and definitely from a momentum standpoint to SPY. So there was this level on SPY, and it ended up being a very clean short for those that were on top of it and took it. That's 618, so you had the big drop, you had the bounce to the 618, and then that sets you up for the fall back to the lows. So on SPY here, I'm looking for a retest right back down here to these lows. Frankly, I think you'll bounce there, but I don't think it's going to hold. So I think SPY here is going back to 400, which would be a very considerable drop from here. It's about 9 to 10%. And we can use this as the shortcut for everything, right? Because the SPY here looks better than most indices. The Dow looks a little bit better in the short term, but not that relevant. So we'll use the SPY as the proxy for the entire market because, one, it is a proxy for the entire market, and two, it has better structure than the Qs or the IWM, right? So if the SPY breaks, it's going to take the weaker indices with it. So here you can see that you now do officially have an 821 weekly cross to the downside. You have an active sell signal when you have not had any before. And you've broken your trend oscillator here. So you have this high and then you have a higher high, but price went down, right? So when that, or momentum went down, price up, momentum down. When that happens, that's a giant divergence and just creates an enormous amount of instability in price that really at this point can only be resolved by peaking it lower. So I would look for 400 here on SPY. And these signals are really just, that's pretty much this combination of these two signals with the divergence, the break, and the sell signal, and then the negative EMA cross. That's like the holy grail of bad setups, right? So that's the reason that I'm telling you, I think, one, it's going back to these lows. The lows might bounce, but it won't hold, and in my opinion, of course. And then from there, that takes you down to 400 on SPY. So I think that covers kind of the main thing that I wanted to share with you. I think you can kind of draw your own conclusions from this because, again, here's a screenshot that I showed of my view on Tastyworks, and you can see here everything is red, right? Everything. So it's very binary here, and as long as you understand the two things that we've talked about, which is the VIX and the SPY, and you understand they both have opposite setups. The VIX has a setup to go much higher, the SPY has a setup to go much lower, and it's just getting started. That should color your view on everything. And then the sectors to focus on are the same sectors that I told you last week. Really, the only thing to focus on long here is going to be energy. And even that might not work. but that looks the best and it actually plays well with what's going on with the market. The sector to most avoid is going to be small caps and technology, specifically software stocks. So be very careful with those because higher interest rates, especially when they're expected to go even higher, really hurts software stocks specifically. The other thing is Oh yeah, the other thing is the yield curve, right? So I talked to you guys in this channel last week on the yield curve. I won't cover it again because you could just go through our channel and find my video from last week, and you'll see the signal that I'm using that's actually the core of the idea, right? So you don't want to have a narrative in markets, you don't want to tell yourself a story, but if you do, then it has to be something that works with the charts. And if you go back and you watch last Friday's video, you'll see that the story that I'm telling you around the yield curve, which is the central signal for the entire thesis, continues to play out, and now you're starting to see it break down in the stock market as well, right? So if you're interested in that, just check out the video from last Friday. I think it's pretty informative. And then also check out our blog, because there's going to be a blog post on it on the simplertrading.com/blog page, and then you can read up a little bit more about that if you're interested. It's a very interesting signal. It's a signal that's happened 4 times over the last 40 years, and each time it's done the exact same thing, except this time. This time it's doing something different. And my read on that is that is actually going to be a very big problem for equities all through this year until it's resolved. So if you're interested in that, check that out. And then the main thing to understand from this video, understand the VIX, understand the SPY. That's all that matters for now. And then understand where you should be and where you should not be. You should be in energy, materials, banks, although banks are a little suspect here. But these 3 things benefit from higher rates. Energy, commodities, and banks. And then you should definitely avoid consumer discretionary, technology, and then utilities, because those do not benefit from higher rates. All right, guys, that's my time. If you have any questions, comments, go ahead and drop them down in the chat below. Give us a like before you go somewhere else on the YouTube. It really does help us with the algorithm. And I hope you have a good weekend. I'll see you next Friday. Cheers. Hey guys, this is Sam, and I'm the Director of Equities at Simpler Trading. I want to thank you for watching this video, and before you go somewhere else on the YouTube, I'd like to ask that you comment and like the video. It really does help us out with the algorithm and getting the message out to more folks who like to see our content. Also, be sure to click the bell notification and subscribe to our channel so that you never miss anything that comes out. If you want to watch us trade in real time using our own money, come over to simplertrading.com and learn how to sign up. I hope you have a great rest of your day, and we'll see you for the next video. Cheers.